Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil markets. I'll start with Paris rapeseed. The most recent move higher originated from the drop made in the changeover gap at the end of January. It started from where the market halted back then at the combination of the optimized February 2021 to date uptrend, currently at 646 and a quarter, and the rising long moving average, currently 655 and a quarter. Prices then utilized these two supports as a base for a move higher, slowly filling in the gap and leaving a smaller one behind in between 710 to 718 even. The next event was a combined bearish dark cloud cover pattern and bearish double made 4 Wednesdays ago. On its own, it's not that significant, but it did allow the creation of an upper trend line, currently at 857 and 3/4, for a smaller ascending narrowing wedge pattern. The lower trend line for this pattern was created on that following Tuesday, currently at 790 even. The upper trend line is a 3-stroke 4-pointer, whilst the lower trend line is only a 2-pointer. Right now we are once again testing the upper trend line for this pattern. Now, this smaller ascending narrowing wedge pattern may well be the new kid on the block, as there are some longer term patterns, ones I have spoken about, right at the start of this year that also may be considered or must be considered. For these, I must again refer to my annual review on Paris rapeseed, made at the very start of January this year. In this I refer to a hesitation that the market made and quote, between October and December last year, on the longer term chart, this doesn't show so well, but it is there. Thus, this has led to yet another target topside. Target X2 is in the 834.5 area. I know that this is a big ask, but I can only put down what I see. End of quote. Well, this target, X2, was achieved on Tuesday last week. It seems such an ask as drawn back in January, when we were in the 750, 760 area, was not such a big an ask as it seemed back then. This brings me to some further comments made in my annual review, and I quote, this leads to my final points. Since May last year, we have formed a newer, much more acute bull channel, currently 634 to 835. To me, it is super acute and thus unsustainable, but it is there, and I will not dismiss it just because of acuteness. End of quote. While this channel is still there, and I've transferred it and finessed it on this daily chart, such that I'm more inclined to refer to it as the February/April 2021 to date the larger ascending broadening wedge pattern, rather than a bull channel. This pattern is the outlying, corralling, bullish influence on this market and is showing the way higher. We have had enough of a market move higher that last week the upper trend line was pierced, though not broken. The breaking of this pattern has been done this week as well. Now, as this is a monthly pattern, we'll have to wait until the close of this month to see if it is a definitive break higher, and likely for the end of May for the consecutive confirmation of that. However, this break higher from the larger ascending broadening wedge pattern is happening right now. The only immediate resistance is a new upper trend line, finessed if you like, since mid-October 2021, currently at 869 and 3/4. Winnipeg canola. The recent move higher here has run into some resistances from two sources, and now actually a redundant third. The first was from the 50% projected Fibonacci line for the big action back at the end of February and into early March at 1142.90. The second was, at the time, the then upper time, currently at 1215.90, of the mid-January to late February bullish Andrews pitchfork. This upper time was breached repeatedly, but importantly, not broken. The third, now redundant resistance, was a market function. It was the changeover gap, 1097.20 to 1114.60. This gap had tempered the market's attempted moves higher, but at a cost. However, this has now been filled in. A fourth has now emerged, the fourth factor, but it's not that strong. It was the rising middle tine, which had acted as support but is now an immediate resistance. Interestingly, the short moving average, currently at 11.2320, still remains as support. Thus we have had a serious attempt higher, but though we have made new highs, it has been at a cost, as the new highs have barely reached just a little bit higher. Only if we can have consecutive closes below the lower tine, currently 11.1310, can we even entertain the idea. At this time, we should look at this market still having the bullish incentive and maybe just taking a breather. Please note, all recent attempts down to the lower tine have failed to come close. The only issue is that this bullish pitchfork is quite acute and further attempts ought not to be ruled out. Bursa Malaysia crude palm oil. The September to December 2021 bullish Andrews pitchfork had until the end of February been the most recent driver in moving the market higher. Then 6 weeks ago, prices broke above the upper tine, currently at 76.32. We then had some apparent consolidation as the market next moved up over the 50% projected Fibonacci line at 74.92 before stalling, ahead of the 100% projected Fibonacci line at 81.96, before then dipping back down into the depths of the same pitchfork. Despite a couple of gaps on the way down, the dip was limited by a combination of the significant late February highs between 67.81 to 67.90 and the lower tine, currently at 60.53 of the previously mentioned broken Andrews pitchfork. All this generated another fresh attempt higher in between the lower tine and the middle tine, currently at 68.42. So, what has the market achieved in all this action? Well, the immediate consequences have been twofold. Firstly, we have a double top for the late February to date action. Now, I have been conservative and measured this possible pattern from the second top, not the higher first top. Thus, we had an initial target X in the 57.65 area, with a secondary target X1 in the 54.35 area. The initial target X was reached, though it looks like the secondary target is just a little too far. I will retire these targets after this commentary. The second thing to observe is that the gaps in the market, on the way down, are roughly bisected by the rising tines of the broken September to December 2021 bullish Andrews pitchfork. This is the pitchfork that had been showing the bullish angle attack of this market until very late February. Now, this may all be coincidence, but I'm inclined not to think so, and that these gaps may be an echo of the previous tines. That is why I've kept the broken pitchfork on the daily chart and would suggest that a special watch be made on the tines. That being said, we have already filled in the lower gap between 65.67 and 63.59. Thus, we now have the late February interim highs as immediate resistance in the 67.89 area and the rising short-medium moving average, currently at 63.02, shored up by the short-moving average, currently 63.08, acting as supports. Just please remember this. We seemingly still have the bullish Andrews pitchfork still controlling this market, and unless this is broken and properly broken on the downside, then this pitchfork will still show the bullish incentive that is endemic in this market. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.